Today, we begin with a development that banking regulators, consumer advocates, and financial analysts had feared, debated, and quietly prepared for. A rule change that unfolded not over years of slow negotiation, but in a single regulatory session. A single session that will affect how millions of Americans access their money. A single session that will reshape the fees you pay, the limits on your account, and the rights you have when something goes wrong. A single session that could either protect everyday depositors or quietly shift more power to the institutions holding their funds. What the Federal Banking Authority did today crossed a threshold the consumer protection groups had hoped would hold until more public input was gathered. And when that threshold moved, financial watchdogs did not hesitate. They responded with clarity, urgency, and a level of public alarm we have not seen from this community in years. For months now, there had been signals. Not official announcements, not formal press releases, just signals. That federal regulators were preparing something significant in the way they oversee commercial banks and consumer deposit accounts. The regulatory body has been methodical, yes, but they have been unusually quiet in their methodical approach. Their moves have followed a certain rhythm, a cadence, almost a predictability. But what set off alarm bells in consumer finance circles this season was that the rhythm went silent. Analysts who monitor regulatory filings and agency meeting schedules know the indicators. The pre-rule comment period announcements, the informal industry briefings that always precede major rule changes, the uptick in lobbying disclosures from major bank holding companies, the sudden reassignment of senior staff at key oversight bureaus. All of that went quiet. And whenever regulatory machinery goes quiet just before a scheduled session, it means something significant is about to get very loud, very fast. Consumer groups had submitted comments, independent economists had filed briefs, several members of Congress had sent formal letters requesting a delay pending further review. None of it slowed the process. The vote was called, the session was held, and today, the rule passed. Early this morning, financial news services detected what insiders described as a compressed regulatory action, including rule language that had not been made available for public review in the standard window required by the Administrative Procedure Act. These are the kinds of procedural maneuvers that regulatory bodies only execute when they are signaling something very specific: speed over process, institutional priority over public comment, or a deliberate decision to limit the window for legal challenge. Legal observers didn't know which category this fell into, or whether, in fact, it fell into all three at once. But what they did know was that the regulatory posture had shifted. And when a federal agency shifts its procedural posture without explanation, even by a narrow margin, consumer attorneys pay close attention. Here is what the new rule actually does, in plain terms. It modifies the framework under which banks can alter the terms of deposit accounts, including checking accounts, savings accounts, and money market accounts, with reduced notice requirements to customers. Previously, most account holders were entitled to a meaningful notice window before their bank could change key terms. Overdraft fee structures, minimum balance requirements, interest rate calculations on savings products, and dispute resolution clauses. Under the new rule, that window has been compressed. Banks operating under federal charter now have broader authority to update account terms with shorter advance notice, and in some cases, the notification can be delivered digitally, buried inside a routine email update or a terms of service revision, rather than through the more prominent direct communication customers had previously been entitled to receive. The response issued by consumer protection organizations tonight was not routine. It was not symbolic. It was not procedural posturing. It was urgent. Advocate after advocate, speaking at emergency briefings and through public statements, described the regulatory body's move as opaque in its process, consequential in its reach, and perhaps most importantly, asymmetric in who it benefits and who it exposes. Because a rule that shortens notice periods only works as a protection mechanism if the institution using it acts in good faith. And the concern tonight is not about good faith. The concern is about what happens when it isn't present. Consumer advocacy groups did not hesitate. Within hours of the rule's passage, 3 major organizations announced they were initiating formal legal review of the rulemaking process. A coalition of state attorneys general issued a joint letter signaling they may pursue independent state-level protections to fill the gap. And at least 2 members of the Senate Banking Committee called for an emergency hearing. These weren't routine responses. These were coordinated, strategic, and fast. The kind of institutional reaction you only see when the people watching the system believe that something genuinely important has shifted. Tonight, sources close to the rulemaking process confirmed that the new regulation covers 3 primary areas of your banking relationship. First, overdraft and fee notification. Banks will now be permitted to modify their overdraft fee structures, the amounts charged when your account goes into the negative, with a shorter advance notice than previously required. If your bank currently charges you $35 per overdraft transaction and decides to increase that to $45, the window in which you must be clearly notified before that change takes effect has been reduced. Second, savings rate adjustments. For variable rate savings products, including high-yield savings accounts and money market accounts, banks now have greater flexibility in how and when they communicate rate changes. This is particularly significant for customers who selected their institution specifically because of a competitive interest rate, and who may not realize that rate has been quietly adjusted until they check their statement. Third, dispute resolution terms. Perhaps the most consequential change is the modification to how banks may update the arbitration and dispute resolution clauses embedded in your account agreement. These clauses govern what you can do and where you can go if something goes wrong with your account. Under the new framework, updates to these clauses can be delivered with less direct communication than before, meaning customers may unknowingly waive certain rights simply by continuing to use their account after receiving a digital notification they may not have fully read. This is what made Watchdog's warning so urgent tonight. The rule isn't just symbolic, it is operational. It represents the kind of structural change that affects everyday account holders in tangible financial ways if left unexamined. And here is where the story becomes even more layered. Legal analysts now believe that this rule was designed, at least in part, to test the responsiveness of state-level consumer protection frameworks after several years of federal preemption debates weakened those protections in some jurisdictions. The question being asked in regulatory circles tonight is whether state governments would fill the gap, or whether account holders in states with weaker consumer finance laws would find themselves with meaningfully fewer protections than those in states with stronger independent frameworks. Consumer attorneys speaking with financial press under anonymity described the rule's design as a pressure test, a way to determine how much institutional flexibility banks could gain without triggering a coordinated political response. But tonight's response from advocacy groups, state officials, and legislative offices proved that the answer is not without a fight. Experts speaking to this issue are not saying that the rule is necessarily illegal. They are saying that it was rushed, that it tilts the balance, and that it creates real practical vulnerability for account holders who are not paying close attention. Their concern was not only substantive, it was structural. Precisely calibrated enough to identify which populations bear the most risk. Lower-income account holders, elderly customers who rely on paper communication, and small business owners who manage high-volume transaction accounts where fee changes compound quickly. That population matters because it shows something important about who this rule was not designed with in mind. It shows that regulators are not operating in a neutral space. They are operating in a space shaped by institutional pressure, industry lobbying, and the long-standing tension between bank profitability and consumer protection. As reports continued coming in throughout the day, we learned more about the breadth of this rule's reach. Major national bank holding companies, which together hold accounts for more than 150 million American households, fall directly under this new federal framework. Regional banks operating under federal charter, not state charter, are also covered, meaning the rule applies far beyond just the largest institutions. Digital-first banks and fintech-adjacent banking products, which have been growing rapidly and which tend to communicate with customers almost exclusively through app notifications and email, face a particularly significant question about whether their existing notification practices now meet or merely technically satisfy the new standard. This wasn't just a regulatory adjustment. This wasn't just a paperwork change. This was a rebalancing of the information architecture between banks and their customers. This was a shift in the default assumption about who bears responsibility for staying informed. And that shift moves the burden from the institution to the individual. And that shift is the one thing consumer protection law has historically worked to prevent, because it consistently produces worse outcomes for the people with the least financial sophistication and the least time to monitor fine print. Remember, the argument from deregulation advocates has always been that banks operate most efficiently when freed from what they describe as excessive administrative burden. They argued that shorter notice requirements don't harm customers, they just modernize communication. They argued that digital notification is equivalent to or better than mailed correspondence. They argued that the market would self-correct, that customers who didn't like new terms could simply move to another institution. But tonight, the evidence from prior rounds of deregulation tells a more complicated story. Account switching rates, even among dissatisfied customers, remain extremely low. The friction of changing banks, updating direct deposits, relinking bill payments, transferring account history, means most customers stay even when they are unhappy. Overdraft fee revenue continues to represent a disproportionate share of banking income, largely extracted from the accounts of customers who can least afford it. And the arbitration clauses at the center of tonight's rule change have, in prior studies, consistently reduced the ability of individual account holders to seek meaningful legal recourse when disputes arise. What makes this moment so significant and so contested is that this rule was approved at a time when the broader regulatory environment is under enormous political pressure from multiple directions. Banking industry groups want maximum flexibility and minimum administrative overhead. Consumer advocacy organizations want stronger, not weaker, notification and transparency standards. State governments want clarity on whether federal rules preempt their own consumer finance protections, or leave room for states to do more. And ordinary account holders want, above almost anything else, to simply understand what their bank can and cannot do to their account, without their explicit knowledge and consent. The regulatory body is balancing these competing demands while simultaneously navigating a period of significant institutional transition and political scrutiny. And when regulators in that position move quickly, without extended public comment, they are rarely doing it from a position of uncontested clarity. They are doing it from pressure. They are doing it because the window to act, before the political environment shifts further, is narrow. The Consumer Protection Coalition's public statement, now distributed to every major financial press outlet, was designed to signal that advocates are not willing to allow this rule to take effect without a sustained, organized challenge. Officials said plainly that the regulatory body's compressed timeline was inconsistent with the transparency and public participation standards that meaningful rulemaking requires. That is careful language for, this was done too fast, without enough public input, and we believe the process was compromised. You don't usually hear that tone from legal advocacy organizations unless they believe they have grounds to act, and intend to. Meanwhile, a leading consumer finance attorney addressed supporters in a direct, unflinching statement tonight. She said, "This rule changes the terms of your banking relationship, and most account holders will never know it happened." She said, "The notice you receive may come as a single email, in language designed to be ignored, arriving on a Tuesday afternoon when you are thinking about anything except your deposit account agreement." And she said, "Our job, starting tonight, is to make sure that silence does not equal consent." These are not rhetorical statements. These are warnings from people who understand, in granular detail, just how much the fine print of your banking agreement shapes your financial life. Here is what makes the situation more complex. This rule was not announced in isolation. Along with this primary action, several related developments are unfolding simultaneously. At least 2 major national banks have already updated their terms of service pages in the last 48 hours, in what appears to be anticipation of the rule's passage. Not égal. A separate proposal under review would further expand bank authority to require digital-only communication as the default for all account notices. eliminating paper mail as a standard option for customers who have not explicitly opted into electronic-only delivery. Lobbying disclosures filed this quarter show a significant increase in bank industry spending on federal regulatory engagement, specifically targeting the Consumer Account Notification Framework. All of this happened within the same compressed regulatory window. When institutions move multiple pieces at once, it means something larger is underway. And the shape of that larger strategy is what analysts are now working to map. Analysts are now considering several possibilities for how this unfolds. One is that the rule survives legal challenge and becomes the new baseline, and that banks begin systematically using the new flexibility to reduce the clarity and prominence of account change notifications. Another is that state attorneys general pursue independent action, creating a patchwork of state-level protections that functionally restore much of what the federal rule removed, but only in certain states, leaving a geographic gap in consumer protection. A third possibility, the one that most concerns advocates tonight, is that this rule serves as a precedent, and that future rulemaking sessions use it as justification to compress public participation timelines even further, establishing a new, faster normal for regulatory action in the consumer finance space. But tonight, consumer organizations, legal advocates, and state officials took several of those options off the table. They didn't wait to see what the rule would produce in practice. They didn't file mildly worded requests for reconsideration. They didn't simply issue press releases and move on. They moved to challenge the process, build a coalition, and signal to both regulators and institutions that this moment will be contested. What we are watching now is a test of institutional accountability. Regulators want to see whether the new framework can be established before a coordinated opposition forms. Advocates want to show that the public's right to meaningful notice, in their banking relationship as much as anywhere else, is not negotiable. Legal bodies want to prevent the normalization of compressed rulemaking that could affect not just banking, but every regulated industry where consumer agreements define the terms of daily life. And ordinary account holders want to know, what does this mean for me, right now, today? Tonight, sources inside consumer finance advocacy who are actively monitoring this situation say the following. They say account holders should log into their bank's website or app in the next 72 hours and review their current account terms and notification preferences. They say customers who receive any email from their bank about updates to your account agreement in the coming weeks should read it carefully before deleting it, because under the new rule, continued use of the account after receiving that notification may constitute acceptance of any new terms included. And they say the decision by federal regulators to compress this process is likely part of a broader institutional strategy intended to establish new defaults before public awareness catches up. But advocates are not standing down. In fact, the response mobilizing tonight, coordinated, legally grounded, and building across multiple channels, sent a message to institutions that consumer finance is being watched, and it sent a message to regulators that speed without process is a vulnerability, not a strength. As the days ahead unfold, we expect more details to emerge about exactly what each major bank intends to do with the new flexibility this rule provides. But what we do know is that tonight's response from advocates was timely. It raised the public alarm before most account holders were aware of the change. It created legal and political friction that will slow and may ultimately halt the rule's most consequential applications. And it reminded every institution operating under this new framework that their customers are not passive recipients of fine print. They are people with legal rights, political representation, and increasingly organized advocacy on their behalf. What happens next will depend on what the regulatory body and major banks do in the coming weeks. If they proceed without adjustment, this moment will be remembered as the point at which the consumer finance protection gap began to widen. If they respond to the pressure with genuine transparency and extended timelines, advocates have already shown they are organized, ready, and watching every move. And tonight, for the first time in this regulatory cycle, the institutions that push for this rule appear to be reassessing the speed of their next steps. The industry is quiet, unusually quiet, and when regulatory beneficiaries go quiet after a contested win, it means they are calculating, measuring the political temperature, watching the coalition forming against them, deciding how much to press and how much to wait. Because tonight, they learned something they tend to learn only when they move too fast: that account holders are paying attention, that advocates are organized and they move quickly, and that a rule passed in a compressed session can be challenged, contested, and ultimately reshaped by people who understand that the terms of your banking agreement are not just paperwork. They are the architecture of your financial life. This story is far from over. But tonight, one thing is clear: the new banking rule is real, and its effects will be felt in millions of accounts across the country. The fight over whether those effects are acceptable has already begun, and the outcome will depend on how informed, how organized, and how persistent the public chooses to be in the weeks ahead. We will be here, tracking every development as the next phase of this story unfolds.